Good morning, everyone. Today is our fourth day actually, of our classes, and this week we're going to be concentrating on mortgages. We're going to talk about the different types of mortgages. Yesterday in our buyer class, we talked a little bit about why it's so important to speak to your buyers about getting pre-approved early on, about profiling your buyers. Is it their first time or have they already owned 10 homes? What's the terminology that's used? What are the different types of mortgages? What is the process? And things to say to help them. So we have with us Sarah Bear from Ross Mortgage, and she is going to tell us everything we need to know, especially about working with your buyers and how to use scripts to help them understand the importance of getting a mortgage early, getting a pre-approval early on. So welcome, Sarah.
Thank you, Susan. Happy to be here today to talk about mortgages. So as Susan said, my name is Sarah Bear. I work for Ross Mortgage. I'm a mortgage loan originator there. And just to give you a little background on Ross Mortgage, we are probably one of the last independently owned mortgage companies in Massachusetts. And what that means for you and what that means for us is that we're a local mortgage company helping good people, helping good agents, and really working with an individual, okay? Our processing center is located right in Westboro, Massachusetts, so literally all of our openers, all of our processors, our back-end team, underwriters, all the decision makers are right in Westboro. The difference with that is that, these larger mortgage companies and whatnot, you could have, teams that are in Texas and Minnesota and Florida and trying to collaborate together. If I need an answer from my team, I can just get in my car and drive there if I really need to. But so what that overflows to you guys is that support system is readily available for you. Nice. 100%. So I want to just, this will be, collaborative, so feel free if you have questions now, if you have questions as we're going through this, please ask them. If you're thinking about it, someone probably is as well. So we'll follow the book. There's some good tips in here and just the guideline. The first place that we're starting is when you're meeting with your buyer or even your seller. The first question that you'll want to ask is, are you pre-approved? And most times people don't understand what a pre-approval is. There's two different types of pre-approvals. One is a pre-qualification, and then the next step is a pre-approval. A pre-qualification realistically means not much, okay? It's nowadays there's a lot of online applications that I can literally go in and say, I make $1 million a month. I have, no debts, and the computer automatically spits out, oh, Sarah, you're approved for a $5 million house. Well, that's not true. So what we do is really we front load our process when we're meeting with potential buyers. And what that means is that we're sitting down with our buyers, whether it's face-to-face, whether it's over the phone, Zoom call, or if they do want to fill out an online application, we do have that availability for them. But what we're doing is divulging a little bit further into that application. So we're going over that application, their income, their assets, everything that's on there. The pre-qualification is, like I said, it's really not looked at critically. You're just filling out information online and spitting out.
What are the ratios currently for first and second? That percentage of pity. What's the ratio for that?
The debt ratio?
Yeah.
It depends on the different programs, and we'll go through that. But that is a good question to ask. So you'll want to make sure that a pre-approval is done on your buyers, and also you're going to want to make sure that if you're listing a house, if you do receive, offers, is that
right
pre-approval valid? Is it true? And one way that you can do that is really just picking up the phone and calling the loan officer.
Okay. I have a question about that too. What about it being up to date?
So pre-approvals are good as long as a credit report is good for. So every mortgage company is different, but typically it's good for about 60 days.
Okay.
I'd say that if you do get an outdated pre-approval, you'll want to look into it a little bit further. So even if it's 30 days old,
Ask them for an updated one.
yeah, I would ask them for an updated one just to be sure, okay, because things change. So the process of going through a pre-approval is you got to make sure, one thing that we run into a lot is, you meet somebody and they say, oh, well, you need a pre-approval. Okay, well, here's their information. Okay, and we call them. And try to get them all settled and get them their financing secured. Well, you need to really identify the people that you're working with, how strongly they feel about buying that house, because you don't want to waste your time, right, and showing them all of these houses if they're not truly pre-approved.
Correct.
So what you guys talked about yesterday is really identifying and coaching your buyers through taking that first initial step, because it really is important, especially on the selling side too. If you do have a seller that is going to be buying as well, you need to make sure before you list their house, make sure that they can be pre-approved. We've seen situations where you have an individual who realistically thinks, oh, I can afford this or I can afford that, and they sell their house and it's on the, you put it on the market, you put all the time into it, and they can't get pre-approved.
So again, back to that. I mean, we need the scripts to help the people understand that. And so many times they'll say, "Oh, I know I can do 400 or whatever it is." And what I would say to them would be, and we talked about this a little yesterday, I would say, I want you to be comfortable in the range that you're doing so that you're not overextending yourself. And that's a hard thing to get them to understand when they're like, well, why can't we just go out and look without speaking to a mortgage person?
Yeah.
And you say, I'm just trying to make you be in the most comfortable range that you can be, and depending on the equity that they have in their house.
So that's also a great thing. A lot of sellers don't understand the financial costs of selling their house. There's realtor fees, there's attorney fees, and there's, if it's in Massachusetts and New Hampshire, there's tax stamps. A lot of times I see sellers that they don't understand what their bottom line really is, and they're on the phone with me saying, oh, I have $75,000 to put down on the new home. But realistically, it after all of their fees and whatnot, it could be down to
They've lost 10,000.
So that's just really something to identify, especially in the upfront pre-approval process. And Susan is correct. It's how we look at this, and our job is we're helping people, right?
Right.
We're helping people. On my end, it's a financial process, but also it's a personal process, right? So we're going to make sure that they're financially able and that they personally want and are comfortable with their payment. So to Susan's point, it's really kind of taking these people in, your buyers, your sellers, and conveying that we really want to take care of you and we want to make sure that payment works for you.
Exactly.
Right?
I have another point. So in Stacy's book, How to Hire a Lion, one of the chapters talks about your team. And this is why at the beginning, when yesterday we talked about your commitment to your buyer and your buyer's commitment to you. When you tell the buyer that you have all of these people on your team to help them have a smooth transaction, you're explaining to them why your mortgage person is so important from the beginning of the transaction, so that they're not overextending themselves when they go out to look, and so that you know what path you're on. And I also like Sarah bringing up the seller side, because I wouldn't even thought about that. I recently sold a home, and the person had owned it for 30 years. I thought they would have had no mortgage, and they were into it for all the money because they had refinanced twice. So they they had no equity in the home and had no money to go on and look for something else. So that was a whole different financial ball game. So Sarah's trying to pull complete information out to help them do what's comfortable for them. So that's why it's important.
So bottom line is that when you're meeting with these people, conveying that really they need to look at the financial perspective of things, which, you know, sometimes could be tough to get them to go into that direction, but it's a necessity. Okay. So that's your, you know, that's realistically that's your main, you know, your main job as far as like, you know, the mortgage. That's the first step to let your buyers and sellers know. In this book, we kind of were looking at the different types of mortgage loans. The first one, and I'll go through this with you. It'll give you some information, and we're not you know, I don't expect you guys to be mortgage experts because you're not a mortgage expert. You're a real estate agent who's amazing, right? But if you have these kind of tidbits of information, you will come across as more credible to your buyers and your sellers. You know, don't ever answer any questions about rates. Don't ever answer any questions about mortgage programs. You know, direct those calls to us because, you know, I'm not answering questions about, you know, square footage and bedrooms and whatnot. So there's different types of mortgage loans, right? And there's different types of mortgage products. So the difference with Ross Mortgage, right, is that we have about, you know, 50 to 100 different types of mortgages, okay? Because we only do mortgages. So if you look at us compared to, say, a bank or a credit union, a bank or a credit union is really, they limit their mortgages. They only have maybe 3 or 4 different programs. Okay, so, you know, if you're an 800 credit score and you have 30% down, great, you know, you're fabulous. But anything outside of that, you're not going to fit in with a bank or a credit union. Okay?
Yeah.
So the types of mortgages that I don't expect you guys to know the 100 types of mortgage programs that we have, but this will give you a good idea of what's involved in those programs. Okay? Fixed rate versus adjustable. The most popular mortgage, you know, program out there right now is a conventional 30-year fixed rate. Everybody wants a 30-year fixed rate.
What's the rate currently with you?
So it depends on this. And good question, because what rates are different. Okay, it's made up of your credit score. It's made up of how much money you're putting down. It depends what type of program that you're in. So, you know, right now rates are the best that they've been in 2 years.
They're flexible.
Yeah. So what you
per thousand? Could I ask you just roughly?
So, like, if you're looking at a VA loan or an FHA loan or a USDA loan or a conventional loan or a jumbo loan or a high balance loan, you're going to get 6 different rates. So, and it depends on a credit profile. But
I think you say like a 30-year fix, right?
If you have an 800 credit score and you're putting, you know, the minimum down, it's probably low 4s.
$4 per thousand?
Rates. Right in like 4 to 4.5.
Percent.
I know percent. I know, but how much is it per thousand for the 4.5? I know it's 4.5. How much is it per thousand if you want to calculate it?
So
Like
I'd
$40 to $45.
Yeah.
$40 to $45
Not per thousand.
per thousand.
Yeah, per thousand.
Oh.
So fixed versus adjustable. If anybody is asking you to, the only reason I would put somebody in adjustable rate is that, you know, one, if they're a gambler, you know, I'm not a gambler myself. But adjustable rates do work well for some people. It's looked at negatively, but if you know that you're only going to be in your house for, say, 3 years because you're here for work or you're relocating for any reason, you know that your end date is 3 years. Well, you might want to go into an adjustable rate it's what that means is it's fixed for a certain amount of time, and then it adjusts every, you know, depending on how it's structured.
Gambling on where it's gonna go.
Exactly. Right. So that's the gamble. Like I said, most people prefer fixed because it's safe.
Correct.
Right. But if you see an adjustable rate, you know, if someone's saying I do want an adjustable rate, it may be for a certain reason. It's not negatively looked at. The only reason that, you know, if somebody's in an adjustable rate that you see, you know, it might be their preference. So the way that mortgages run is there's some programs that are are backed by the government. And the three programs are the USDA loan, the VA loan, and the FHA loan. Okay? FHA loans, they have a bad rap, but they're actually, it's an incredible program for somebody who might have a lower credit score, that has, 3.5% to put down on that mortgage, and they're able to get into a house, right? So if you have a 620 credit score to 700, sometimes it's a tough range. It might require more of a down payment. It might be, you might be limited to how much you can purchase. But what FHA does is, because it's government sponsored and government backed, you're still able to put down 3.5%. And also, if it's a multifamily, it's 3.5% as well.
Is that only when you first time buyer?
Nope.
Really?
Yeah, it can be your second one.
So you also may see sometimes in an MLS listing, this house is not eligible for FHA or whatever, and that is because, you want to answer that?
Yeah. So FHA has a whole nother set of rules. But it's nothing too extravagant. And basically, because it's government backed, they want to make sure that the house there's more safety regulations. Okay? So those safety regulations, a lot of times what we see is, if there's broken windows, if there's,
No railing.
no railings on the stairwells,
The chip paint.
the chip paint. So if there's chipping paint on the house, and it's covering the entire house, most likely it's not
risk
good.
liability.
Yes.
Yeah.
The liability of it. Now, if it's a small spot on the porch that can be taken care of for $100, great. But typically, you won't see that in MLS. In MLS, if they're putting in there, it's not FHA approved. It's for a major reason.
Yeah.
Like it could be missing a roof.
Okay.
So now with the chipping paint, is that only on the inside or does that include the outside?
It includes the outside as well. With FHA too, as long as the chipping paint is scraped down to, whatever surface is there, it will be eligible for FHA.
Oh.
You don't have to repaint it.
But you do have to reinspect.
You do have to reinspect. Yeah. So when you're, if you're listing a house, something to be aware of is things like that. The chipping paint. Make sure that the windows are, all secured.
And how do you like, if you're listing that house, how do you find out as a seller agent if it is FHA approved?
So those are the biggest warning signs. It's nothing.
You have to actually call. Mortgage
I
company
would. I'd say just give us a call.
Yeah.
The one thing that comes up that people don't know about with FHA is that you can't be within 100 yards of a gas station.
Ooh.
Either.
Get note of that.
Yeah.
I didn't know that. So in the beginning, I would just say eyeball it. If
Right.
you think there are concerns, then ask Sarah or someone.
Yeah.
But
Yeah.
like with the people that are putting the wording in, they know that there are significant things, and they're like, don't bother bringing
Right.
your FHA people to this because it'll never go for that. Or sometimes they'll even put, this is only a cash or a rehab thing, so it needs significant
Is
work.
that something that you need to have a definitive answer though? Like if you're gonna do it for your first open house, someone
I
asks
don't.
you,
I would say that I wouldn't even put it really in MLS. Unless, like I said, unless it's missing
I think
a
it's
roof.
subjective, yeah.
Because on the other end too, we're coaching if somebody was pre-approved through me, I'm coaching that buyer through, okay, you have to go FHA, but this is what you need to look out for. So if you're going to look at houses, make sure that there's
So
no
that homework is kind of on them, the buyers to.
That's true,
yeah, it's on a lot of it is it falls on the buyer, it falls on some of it does fall on the agent and the mortgage representative,
Buyer
because
agent or something,
I'm not going to have my buyer fall in love with the home that they can't buy.
Right.
So if it's FHA, we're coaching them through that. Now I can't say that if somebody was pre-approved through another company if they're doing the same thing.
Right.
I'm not sure that they would take that next step, but
Can you buy any type of property with an FHA?
you can buy single family home, condo, and multifamily home. So anything that we can typically do residentially.
So you can't buy like just raw land?
Nope.
Yeah.
No.
Or a mobile home.
No mobile homes. Yeah, we don't.
No mobile.
We don't do mobile homes. Well, we do, but
Condo though?
so the biggest thing with condos, the condos. So this condos are a whole different beast, right? In themselves. There's a different set of rules for condos.
Oh,
Okay. So if somebody is looking for a condo, you're going to really want to dig in a little bit deeper with them. Okay. But I'm going to specifically link it to FHA right now, just for the sake of talking about, because we're on the FHA. With FHA, condo complexes have to be FHA approved. So there's an entire process that the condo complex has to go through with FHA to get on their approved list. We have access to those lists. You would have access to those lists
I was
as
going to
well.
say, that might be a good thing for Ross to share with us. Don't forget, if you're working with a condo, that you can look up or ask us to look up whether this complex is on the approved list.
Yep.
Because I had one a year or so ago where their approval had just
Expired.
gone- yeah, expired.
I had the same thing.
Yeah.
They
Across from the
expire?
golf
Oh,
course.
sure.
What's that? What's the ones across from Metal? Across from the golf course, 4 Oaks?
Merrimack Met. Oh,
Right across from
yeah,
4
I don't
Oaks.
know what the name of that is. Yeah.
They can. I didn't know they could. They
Yep, FHA, so once you get approved, it lasts only a certain amount of time.
Quick question: can we call you to find out and
Mm-hmm.
just say, "Listen, Sarah, can you check this one and let us know if it's approved?"
Yes.
Usually
that's-
the
that's
association
good.
would know that, right?
Well, I'm gonna
Not
call
always.
Sarah. Call.
Not all, usually
Sarah.
yes.
Because I called them and they did have information, but it
Thank
had
you.
expired.
Yeah.
Mm.
So yeah, if it does expire, and I've gotten into situations where we can renew that. And if you do have a if you do have a condo complex, one of good thing for you guys is that if you identify a condo complex that's in good shape, right? And what I mean good shape is the reason that they get approved is because they have to look at their financial status,
Right.
their budget,
Right.
their reserves,
Right.
make sure that the condo fees are being paid by all of the owners. Because it's government backed, they want to make sure that that condo association is, running well, because everybody's collectively paying into that association. If 20 people aren't paying their condo fees, they're not going to have enough money for the upkeep,
Right.
and then those 20 condos are going to get foreclosed.
Yeah.
So,
Very nice.
um,
Yeah, I thought doing
Thank you.
stuff, that was my first condo. So
Yeah.
I thought it was a pain.
It is.
yeah, it's just when you do your first condo.
It's an education.
Yeah.
Whether it's buying, if you're working with a buyer or you're working with the seller, this is one thing that realtors don't do.
Go ahead.
Is get the condo documents,
Okay.
but take it a step further and get the actual budget and get the
Oh, I got
condo
all that.
questionnaire.
So when you
So
write,
the condo questionnaire,
I did all that.
yeah.
we should
and
have
then-
mentioned that yesterday.
What's
so
a condo questionnaire?
So it's a form that needs to be filled out, just about everything that I was summarizing. Their financial status, how many owners are in there compared to investors.
Percentage.
Okay.
Yeah.
Oh.
Yeah.
Okay.
So if you hear the
Wow.
word
All
condo,
of that. All of
if you
that.
hear the word condo when you're for your buyers and your sellers, just call
Okay.
me. Just call me. I'll tell you what to do. And then
in the offer, we should have mentioned this yesterday. You should write subject to review of condo
Yes.
docs and current budget.
Yeah.
so if you hear the word condo, just think extra
If you
questions.
if you have a good listing agent, they will put that stuff on there on the paperclip of the MLS listing.
Yeah, no, I've never seen one of those. So,
I like that. That's right. I remember that.
All right, I'm gonna go ahead. When you talk about VA, I have a
VA.
question.
VA loans are offered to veterans. They are, the biggest benefit is it's 100% financing for them. So they don't have to come with a down payment.
But when we write the offer, there is some money escrowed, and then that is returned to them.
Yes. So if when you're writing the offer, you're going to put the initial offer, down payment, and then they're going to have an additional down payment at their purchase and sale. Okay. Now, if their closing costs or whatever costs aren't rolled in, if they have to, pay in say $3,000 and they've already put in $2,000, great. That just goes to what they owe on the closing day,
okay.
right? But if they've put in $5,000 and they only have to pay $2,000, that money gets returned to them. So
At
it's
closing, right?
at closing, yeah. So sometimes, and we run into this a lot with VA. Making sure that even though it's 100% financing, for your buyer to know that some monies are going to be due up front in the offer and the
So
purchase.
so they really don't have to have any,
No.
except for the the closing fees.
They should have at least in their yes, but they should have in their bank account at least one payment. So
Yeah,
we've
yeah,
run
yeah.
into that. I've run into that over the years.
So
where-
the problem that I have found in general with VA is people understanding it, not the veteran, but the potential, the owner of the property. Especially, I'm sorry to say it, but if the owner of the property is older, they're like, I want to take the offer that has the hugest amount of money down as a deposit. Well, they kind of think that they're going to walk off into the sunset with that bag of money, and they don't realize that that money is just held in escrow. And I always try to reverse it by saying that the veteran is the most respected client that you could have, and the money down isn't important. It's the validity of his eligibility and his
Pretty much guaranteed
Yeah,
financing.
yeah.
It's gonna be, you're not gonna have a problem with
and
it.
people. So these 3 loans that are government backed, buyer or sellers especially look at them differently because or more negatively because they're lower down payments. It's higher financing, but realistically,
But the financing really never falls apart at the end, right?
No.
Because it's 100%.
if you have a solid pre-approval,
Yeah,
it doesn't matter.
yeah.
So it's just the strength of trying to convey that, with you, and as long as you're confident in it, you're going to be able to convey that to, the seller or the buyer.
Are there any limitations with VA loans,
As far as
like location or anything, right?
no, not necessarily.
Can't be dishonorably charged, right?
I know you can't, but we do have a program that does work with veterans that have been dishonorably.
wow.
Because, back in, 20, 30 years ago, some veterans were getting discharged for, being gay. And they haven't reverted that.
Wow.
And so, we look at that in a way that we're digging in a little bit further about why they were dishonorably discharged.
Interesting.
Yeah, it is.
And these are not assumable.
They are
VAs.
assumable.
They are assumable.
Yep. VA and all of these loans are assumable.
Okay.
I would tell people if you do, if you ever have somebody who wants to assume,
Yes.
assuming a loan is basically if you have a loan, right, John, if you had a loan and you passed away or you couldn't afford the house anymore, you could potentially give that loan to somebody else to pay. Okay. It doesn't necessarily happen with, with the government loans, you can assume them. I would kind of look at, depending on what the rate is and what your circumstances, that does come up sometimes. But it's nothing that you guys should really ever have to worry about.
Okay, and on the VA loan, they still need the closing costs. Is that out of pocket?
So some fees can be rolled in on the VA loan. A lot of times, if their closing costs are being covered or we're giving them a credit. The one thing with VA loans is really if you have a buyer who's a VA client, there are an enormous amount of mortgage companies that just work with VA loans. Okay? And they are not credible, and they're charging these veterans much higher rates and much higher closing costs.
Wow.
And I see that a lot. I see that a ton, actually.
Isn't that legal? Isn't that legal?
That's it. I don't know. It is legal the way that they do it. So just be sure that it's through if you are working with a buyer or seller. Just make sure it's reputable.
Got it.
So what rate determines a VA loan? Like, what is the rate of a VA loan? I was always under the impression that it was 0% interest, or is it just?
No, they would still have rates. They're lower. So FHA and VA loans, you're always going to find that it's going to be a lower rate. Okay.
Now, with a VA loan, I have a friend that's a veteran.
Yeah.
And like, so, can they purchase a house for somebody else?
I don't know that answer. I would say that it would probably have to be a blood relative.
Yeah.
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 Then they could.
But their name would have to be on the deed.
Yeah.
Yeah.
Okay.
Mhm. Their name would have to be on the paperwork.
Mm.
With VA loans too, if you have, a boyfriend or a girlfriend or a fiance, you're not married, you cannot use that income as a co-borrower. You have to be married.
And you have one eligibility in your.
No, there's other.
Are there?
There's a certain amount of eligibility,
I've seen
so you
older
can.
people that have said, "I've never used my eligibility."
Yeah,
So-
you can use it.
Yeah.
I've done mortgages for people. I've done one veteran. I've done 3 for him.
Oh,
So,
okay.
yeah, you can still use the eligibility. USDA loans are rural loans. So if you have it's a 0% down as well, but it's targeted to a specific parcel of land. So not every property qualifies for this.
More like farmland, right?
Yeah, it's more farmland. It's more rural. So some towns, in a town like Bolton, their USDA is very popular.
Yeah, I was about to ask, are they popular in like right to farm
Yes.
towns?
Yeah.
Dunstable's a right to farm.
Yeah. So Chelmsford, not so much, but
But not just the land though, it's for the property.
Yes.
Zoning, it's
Yeah.
zoning, right? Zoning.
yeah. And there's also certain specs with the USDA loan. Your house can't go over a certain square footage. So it's a niche product that doesn't work for everybody, but works for a lot of people.
Okay.
That's actually very interesting.
Very different. It's like, whoa.
The limits on the jumbo, that's changed, right?
So a jumbo loan, right now in Massachusetts, it's anything over $484,350.
400, how much?
484,350.
350.
Just to give you a kind of a background, 4 years ago, that jumbo limit was 417,000,
Wow.
and that hadn't changed in a long time.
So this is.
So this is
interesting.
really growing.
Yeah.
Yeah.
And what it does, it's helping, buyers get into a conventional loan. So there's a conventional loan, and then there's a jumbo loan. So once you hit over that 484 limit, you're now into jumbo pricing.
Right.
So the rates are a little bit different, and your buyer's file, when it goes through underwriting, is going to be looked at a little bit more fine-tuned.
So when you go get a regular conventional loan, if it goes over that amount, then it automatically become a jumbo loan?
Mhm.
Oh,
Yeah.
sorry, so it's not something that you choose to have.
Right, yeah. No, it's automatic. There's ways around it too. There's ways. So if I have somebody that is buying a $600,000 home and they have $50,000 to put down, okay, we're pretty far away from that jumbo limit. But what we do is we have a certain program that we can split that, the remainder of that 550 into 2 mortgage programs. So you can do a first and a second that's concurrent. So that first one, rather than looking at a higher rate with just one loan, let's look at splitting them into 2 loans. You can get under that jumbo limit and then just make the remainder that second.
That must be
That's
a
interesting.
process, though, huh?
It's actually not. If you're a expert mortgage lender, it's perfect.
Yeah,
That was a good answer.
For you, it's good. Yeah, you don't have
Yeah.
to do that. Okay. Whoa.
So it gives people more flexibility,
Right.
and there's a creative way to kind of look at that.
Help them out.
Yeah.
It's very
So
cool.
just know that if you do have a jumbo buyer, when it goes through the underwriting process, it might be a little bit more time consuming, and more documentation may be asked for than a
Very-
typical
very nice
conventional
program,
loan.
that's right.
It's not going to be anything that's going to
Yeah.
take 60 days or anything. I'm talking maybe like another day or 2. FHA versus conventional mortgage loans. We talked a lot about FHA.
Very cool.
FHA is, it's, if you know the ins and outs of FHA as a, on my end, if I know the ins and outs in FHA and what to look out for and what's going to happen through the process, it's actually a really easy loan as long as it's structured correctly up front. So that's why when I'm talking about pre-approval, if we front load our process, right? So we're collecting every single document that we could possibly need, right? So we almost take off our mortgage originator hats and put on underwriting hats, right? Because we're forecasting what could be needed throughout the process.
Right.
So as long as we're doing that, the benefits of FHA is that it's pretty straightforward. One of the biggest things with FHA to look out for too is that if the purchase price is say $250, and the appraisal comes in at say it comes in at, let me think here. So the purchase price is $250 and the appraisal comes in at $245, right?
Right.
In a conventional mortgage, right, in this market, you're seeing people over asking, right? Like it's all properties are going for mostly beyond what they're listed for, right? So this property, if it's it's your accepted offer is $250, well, the appraisal comes in at $245. On a conventional loan, there's three things that you could do on a regular loan. Number one is you could ask the seller, can you come down on the price?
Right.
Number two is the buyer could come up with the difference of the $5,000, or you meet in the middle, right, with the buyer and the seller, $2,500.
Right.
With FHA loans, that cannot be done. Okay, so they either lower the price to $245,
Got it.
or the borrower walks away.
I got it. Oh, that's interesting. That's,
Because it has to be the buyer that's purchasing the home. The house has to be worth what it is.
They can't receive an anonymous gift for $5,000.
No.
What if the seller pays the $2,500 closing cost?
It would just be they'd have
do
to come
that.
up with a $5,000 credit. It would
They have to.
They have
do
to.
that.
Yep.
Oh.
On paper, it's gotta show.
It's on paper.
On paper's got to show that.
Yeah.
Yeah. So they would have to lower the purchase
With
price.
FHA, is there an income restriction?
No, there's not an income restriction. With FHA, that brings up a good point, Joe. Though, in certain counties, there is a loan limit. So every county in Massachusetts does have a loan limit for FHA, and I can send you those loan limits. They've increased quite a bit. But in Worcester County it's $383,000. In Middlesex,
Is that combined?
The purchase price, the loan amount.
The loan amount.
The loan amount can't exceed that. And in Middlesex, I think it's somewhere around like $520. I mean, it's very high. So, yeah. But thanks for sparking that, because that's a
So
good.
an FHA, if it is at $520, an FHA can technically go over a jumbo loan.
Yes, because there's conventional loans, jumbo loans, but then there's a high balance loan.
Oh, wow.
Yeah, which I don't even want to get into.
It's over my head.
Yeah.
I have another thought, though. What if you put the actual selling price of $245, and then the seller says in there, as an extra, we'll help with $2,500 for the closing cost. Can they do that? Is that legal?
They have to lower the purchase price.
Yeah, but I'm just saying, if they lower it to $250, and everybody agrees to the $245, everybody agrees to that, can the seller then say, I will help with $2,500 at the closing cost?
Sure, if they want
So
to.
that's still legal? Okay, cool.
Yeah.
Okay,
Yeah.
got it. Okay.
I don't think
Yep.
they would.
Yeah, they probably wouldn't want to give up $2,500, but
Well,
hey, I'd be
yeah,
pretty
you
pumped
never
if I
know.
was a buyer.
You never know.
Yep.
Sometimes the sellers will do things. So.
Yeah. All right, so FHA loans, I think we've spent a good amount of time on that. Like I said, the next page just really goes into, they're flexible. Like with the credit scores, we can, anything really down. We can go below 620, but then we got to look at, is it really beneficial for the buyer?
You're the expert.
Yeah.
So remember again about the team and having your mortgage person be part of the team.
Yes.
You don't, how can I say this without, I have a particular instance that I'm going to mention. The buyer has to be honest and thorough with the mortgage person.
Yes.
I was in Boston walking with a mortgage person once, and the buyer called and said to the mortgage person, "Oh, I was hoping you wouldn't find out about that."
I hear that a lot.
I'm like,
Oh my God.
you got to be transparent with them, otherwise how can they do their job, you know?
Yeah, I had a situation where I was working with a buyer for 3 years. Pre-approval, you've been looking for a house for 3 years. Okay, accepted offer, great. Working through the process, a couple weeks in, come in. I sat with him for an hour and a half and went through the next steps. And he goes, "Can I ask you something?" I go, "Yeah." He goes, "I don't know if it's going to affect the loan or anything, but I got a new job." And he went from W-2 employee to self-employed.
Oh.
Now,
Oh.
in all of the coaching that I do on my end, right, you know, the biggest things are don't change jobs, don't buy anything with your credit card or whatever.
Yeah.
He goes, "Well, I was trying," and I said, "Well, yes, of course it's going to affect the loan."
Look at that, you use returns from the previous year and you just started, so you don't have no returns, so you can't do
And
it.
his response to me was, "Oh, well, I brought you all of my paperwork. That's why I kept asking, are you going to need anything else? Are you going to need additional pay stubs?" And he goes, "I figured you wouldn't find out." And I said, "Well, we will find out, absolutely, because at the end of the process, what we do,
I was
especially
just gonna
when we
mention
do
that.
a verification of employment, it's one
Right.
of the last steps that we
Right.
do. So,
Sorry, he's no longer here, and you're like,
Yeah.
what?
Yeah.
Yeah, right.
yeah.
Can't do that.
Yeah,
How
so,
long
and there's,
do you have to be self-employed for?
Well, you have to have enough of your returns to show it, your income
Yeah.
good enough.
Isn't
right?
it 2 years?
at least one, I've had 1 to 2 years.
Yeah.
Okay, 2 years is premier.
Much better.
Yes, but you know
Wow.
we can sometimes work off.
And what do you
1
do
year.
with contract people? You know, especially in,
that's a-
in business,
that's a great
you know, they
question.
can have a contract for 6 months or something like that.
So
you
as
know.
long as they have a history of contract employment, we can do that.
Okay.
Okay, and then we're looking at with self-employed borrowers and contract employers, and you know anybody who's 1099 or owns their own business. We're always looking backwards, not forwards.
Mm-hmm.
Okay,
yeah.
Right.
so yeah, you could be.
You
We're
can't
in,
predict what. Yeah.
right. We could be in the middle of 2019, and you've already made $500,000. Well, guess what? That can be a supporting. That could be supportive
Right.
of what your last 2 years look like, but we can't use that because in the next 6
You
months
can
we
go
don't know
zero.
what's going to happen.
Correct.
Yeah.
So we're always looking backwards
That
on
makes
those
sense.
particular.
Sensible.
Also, we'll talk about credit repair before you leave and your guidance on that. But talk about if somebody's been through, because I know it's coming up next. If they've been through a bankruptcy, how many years you have to wait and that stuff.
Yeah. So this has been more lenient over the past year or two. Prior to that, it really was like 7 years was
Yeah.
like the magic number.
Yeah.
Which was very tough because when we went through the crash in 2008, you know, a lot of people really were strapped and they had no choice.
Yep.
So within the past, you know, couple years, like I said, things have become a little bit more flexible. But with bankruptcies and foreclosures, you're really looking at, you know, some programs, FHA, and some programs could be 12 months. There has to be really extensive circumstances, but 12 months, 2 years to 4 years. There's all different levels for the situation that you've been through. So if you have somebody who comes to you and says, well, I have a foreclosure, you know, I talked to someone, you know, 2 years ago, they told me I had to wait 7 years. They're going to wait that 7 years because they don't know things change,
Okay. So
you know.
Right.
You're the expert. We just send them to you.
Yay.
That's it. You're,
Yeah.
you're the one that they go to. You're the go-to.
As long as I mentioned what I was going to say, we've been doing a lot of first-time homebuyer seminars, and a lot of times people are even afraid to start the process.
Yes.
Yeah.
And again, it goes back to the transparency, but it also goes back to having the faith in the team that you're working with. And I had someone recently who he knew he had a lot of debt, credit card debt and stuff like that. So I had him speak to somebody at Ross, and they worked on it for 6 months or a year. But he had that guidance then to know what things were important to take care of, how to take care of them. And so there's always hope. But reach out to somebody and get a consultation. And by that, you're helping your relationship with your client. Even if they can't buy for 6 months for a year, when they're ready, they're going to be thankful to you that you put them in the right direction.
Yeah. There's never a time when a customer leaves, either on the phone or leaves my office, that there's not a game plan, right? So if somebody comes in and says, "Gee, Sarah, my credit, is really low," I say, "Well, let's take a look." Sometimes it's, they think it's so low and it's not, and they think they have a lot of debt, but they really don't. But it's kind of the stigma that's out there in the media. So my biggest thing is that you're not leaving me with a no and no guidance, right? Because how many people have you talked to that, I went through my bank and they said no? Well, I've heard a lot of that. I hear a lot of that. When I said, well, what's your game plan? Oh, I don't know. They just told me I couldn't buy. So what we do is, cater toward that individual, whether it's credit repair that we can do in-house with them and work one-on-one, or if it's, a plan for down payment or a plan for, there's a lot of creative ways that you can get your down payment now. You could basically, if you say you owned a car free and clear, you could take money right out of, you could refinance your car and take money out of your car if it's worth it.
That's interesting.
Yeah.
Oh, I didn't know this. Cool.
I just closed on a buyer today, actually. They're closing today, and he said, when I first talked to him, he said, "Sarah, we're going to wait 3 or 4 years because we need to have a, save for a down payment." I said, "Okay, but let's go through this now, walk through it," and I said, he had just started a new job, and I said, "Well, what did you do with your 401k at your last job?" He goes, "Oh, well, it's an IRA rollover." And I'm like, that you can take that out penalty free and put it towards your house. No, I didn't know that.
There's advice.
Either.
Yeah.
And he's literally, the first time I talked to him was the middle of January, did a pre-approval then. He's closing on his house today.
He can take it out with no penalty?
Yep, there's no penalty. You still have to pay the taxes, but there's no penalty
There's
fee.
no penalty.
Yeah. So, there's always an answer when people say, "Well, I don't have a down payment. Well, my credit's not good," or "I want to wait 3 or 4 years because I want to pay off my debt." Your advice to them should be, why don't you just take a look now? There might be something that you don't know that Sarah knows, or that us as a team can know. But really, what's to Susan's point is, the team atmosphere is so strong and it's so important, because if you're working with a buyer and you say to them, you're the expert, right? So you have your team in place. This person, insurance, mortgages, everything. You're a one-stop shop, and it's people that you trust and the people that you work with. So you're going to become, you're going to be credible.
Oh my God.
That's right. Until the next guy. PMI.
Private mortgage insurance basically means that you can buy a house now with putting less than 20% down. 20 years ago you couldn't do that.
I love that.
So what it is, it's like any other insurance. So the government looks at it. All mortgages are run by the federal government. Okay, so we have to follow a lot of their rules. So the federal government believes that if you have less than 20% down on your home, that your home is a risk, right? You're more at risk for a foreclosure. So if it forecloses, there's not a lot of equity in that house. For any reason, you can't make that payment. When you do get foreclosed on, now the government has to kind of take over that and take that debt, right? So what private mortgage insurance is just you're paying for that risk. So it's anything like auto insurance, homeowners insurance. You're paying that because you're at risk for something. Okay?
And people always talk about paying that down or off and getting rid of it.
Yeah, people are very concerned about private mortgage insurance. Going back to the different programs that we have, We have a lot of, we have a lot of different programs. Private mortgage insurance is different for every single program. Okay, it could be one flat rate. It could be based on your credit score and the loan amount and how much you're putting down. So it's going to be different for everybody. It could be, some people have private mortgage insurance and it's only $80. Some have it that it's $600. So it's really looking, sitting down with the buyer, on my end, and looking at these different programs and what works for every single, for their budget.
So can somebody that has PMI, can they 5 years into their mortgage pay it off?
Yes.
So
pay another chunk down that will get rid of that, or
the rule with private mortgage insurance is the easiest way to get out of it is to refinance if you have 20% down. Okay, so we're doing a lot of those right now, is refinancing people because home sales and equity has risen over the past year 7% in Massachusetts. Some areas haven't seen that growth in 6-7 years collectively. So now everybody's realizing, I have equity in my house. At that 80% threshold, I could refinance and get rid of that private mortgage insurance. That's the easiest way to do it. The alternative way is that if you know that you have 80% equity, you can go to the private mortgage insurance company and ask them, to remove it. What that entails is an appraisal has to be done, and more often than not, I see them not accepting it. It's a long process. It's painstaking. They don't want you to stop paying your private mortgage insurance.
Of course not.
Yeah.
Unless they like you.
Yeah, they don't.
Even then.
Yeah, they don't.
Can we skip to page 9 and talk about the paperwork that buyers need? Because as you said in the beginning, it's a little daunting.
So and on the left here, credit scores, like going back to the point where, if somebody doesn't understand what their credit score is, I hear a lot of people, well, my Credit Karma says it's 700. Well, we don't use Credit Karma. We go off of your FICO score. And what that is, it's collectively pulling all three bureaus. It's a more detailed history. So your Credit Karma could be 700, but your FICO score could be 800 or 600.
Oh.
Paperwork. So what we're looking at in the pre-approval is we're looking at your credit, we're looking at your income, we're looking at your living history, if you're paying rent, if you owned a home or whatnot. And what we do is we're looking at, like I said, we're looking backwards almost, right? We're not looking forward. We accept that, moving forward, if there's collective things that are happening, like if you're getting a bonus, that's supportive. That's great that that's happening, but we're looking at your history of earnings and your history of living and your rents and what you've been paying. W-2s or 1099s we would need, pay stubs, and tax returns. Those are the three major things that we need to look at. Alternatively, what we would look for too is your bank statements.
Continuous.
What?
Continuous, without any. Sometimes people are not thorough about how they send those in.
Yes, and a lot of people are not. I would say 90% of people piecemeal it. So if you're working with a buyer and you say, you really need to, get a pre-approval, it might be something on the back of my business card. I actually put the list of documents that you need.
Oh, nice.
I love that.
So,
Check that.
yeah,
That's very good.
you could just say to them, this is the information that you're probably going to need. You might want to start gathering that together, because until we have all of that documentation, we can't give a valid pre-approval, and I'm not going to issue that. And a lot of people, they'll say, well, I have $30,000 in the bank. Well, great. I need to see that. And yeah, I might have known you since second grade, but what I'm looking for on that is that you could have $30,000 in the bank, but you could have a large deposit of $15,000 in cash that you just made 2 days ago that we can't source.
Yep.
So bank statements are huge in the beginning because they're looked at we critique them. You can't have just money sitting, I've worked with a lot of people. I have $10,000. Okay, where is it? In my safe at home. I said, well, you got to put it in the bank. because it has to be in there for 2 months at least.
We had somebody yesterday that said they had a client who didn't have checks.
Yeah.
Oh.
More, I think the younger generation.
Yeah.
I can go get them, but
Yeah.
I don't carry them with me. I'm too afraid.
That's like my daughter. My daughter doesn't either. She has no checks. Just to go to the bank or whatever.
Yeah.
Well, we all check, I mean, we all, a lot of us, but we don't carry them with us either.
Yeah.
Don't carry my
No,
check.
but some of the younger people don't have
Don't
Check
even
account.
have.
They don't have a
checks.
checking
Checks.
account.
But you can go get a bank check. All right, page 15, I think, is going to summarize what we've been talking about. It's a nice.
Yeah, and we have, we do have buyer packets that kind of explain all of this and that you can hand off to anybody that you're working with or potentially would be working with. But yeah, this one flyer really kind of summarizes for your buyers or the sellers that are going to become buyers, what steps there are. And this actually does it in a non-overwhelming way, because when people think about mortgages, they think it's overwhelming. Over the past 5 years, we've really structured mortgages in a different way where it's not so stressful. Because if we're doing the work up front and front loading the process, realistically through the actual mortgage process, we're only going to need a couple of documents that are supportive. Purchase and sale, the title, the appraisal, the checks that they write that are cleared. So if we're doing that up front, as we go through the process, they're going to get to the end and be like, oh my God, that was so easy.
Even something as simple as not taking out a new credit card. I mean, it's we think we shouldn't have to say these things, but they might not know. I know somebody that bought a motorboat when they were in the mortgage process. You don't do these things.
Yeah, I had a guy who bought a new BMW a week before he closed on his loan, and he said, well, I thought you wouldn't find out. And I said, well, of course I found out, and you have to go return your BMW, sorry. Unless you to your BMW or your house.
Or your house. Oh, gosh.
Oh
we
my
did.
God.
So there's no hiding. We find out everything.
Tomorrow we're going to have an appraiser here who was recommended by Ross Mortgage. So we're going to go into the importance of an appraiser in the process and all that's involved with that. And one of the things that we want to make a connection with is how we need to explain the job of the appraiser to the seller when we're listing their house. That it's not what we think about the price and not what they think about the price, but how it's going to appraise. So that's another script. And only understanding the appraiser's job as part of the mortgage process will we be better able to help our sellers be ready to understand that, because you don't want them to be nervous 3 weeks down the road when the appraisal comes in. So we're good?
Yep.
Thank you very much. Thank you, Sarah. That was
Thanks, Sarah.
great
You're welcome.
information.